Okay, so welcome to today's session. This is week 14's class for MAC 486162. Okay, we're doing some more standard costing. So we're going to work through a standard costing question. It is a pass question paper. It is test 2 of 2017. So like I said last week, from 2017 and before, cost accounting was in the first half of CTA and financial management was in the second half of CTA. From 2018, financial management became, financial management is now in the first half of CTA and cost accounting in the second half of CTA. And that is why in 2017, you will have cost accounting in test 1 and test 2, 2017 and before, whereas for you guys, your cost accounting is test 3 and test 4. So just take note of that. So I'm just going to switch my screen and we're going to read the scenario and we're going to attempt it together. So remember, we know this is a standard costing question, okay? So this is the same way you would practice when you study yourself. So you know this is a standard costing question, or you know you are studying standard costing. So what you want to do is make sure that a few things, that you run through your mind. Remember, what you're trying to do when you're doing standard costing, you are basically comparing your budget to your actual. And there will most likely be a variance, and you are trying to analyze the variance. Remember, the variance will basically be broken up into two parts, a quantity variance and a price variance. So tell yourself you have to be aware of the following. You must always make sure that you flex the budget. Why? Because the actual units produced will most likely be very different from the budgeted units. Sometimes will be the same, but most likely on a CTA level, it's going to be different. Number two, you want to pick up what is your costing system, because the costing system will drive, the costing system will cause some variances to be applicable and some variances not to be applicable. And then you also want to pick up how do you allocate overheads, because how you allocate overheads, the basis for allocating overheads, whether it's an input or an output, will also have an impact on which variances you can and cannot calculate. So those three things. Then as an additional, when I put your brain on alert, is that you want to be able to identify what is a unit, what constitutes a unit. Like I gave an example last week, that when you sell shoes, a unit would be a pair of shoes, which means it is 2 shoes. Okay, so it's very important. So you want to identify what constitutes a unit of a product. Then you want to distinguish between a unit of a product and the quantity that goes into a product. So for example, the 2 examples I gave last week was, if you were a furniture manufacturer, and let's say you produce wooden tables, a completed table is a unit, whereas one of the inputs, it would be the wood. Okay, so, and wood is generally measured in meters squared. For a shoe, a completed unit is, let's say, a completed unit would be 2 shoes, but the quantity of input may be leather, maybe plastic, and so forth. So it's very important to distinguish between a unit and the quantity of input. And then the second alert is you want to make sure that the measurement units are on the same level. So for example, the wood may be given in, let's say, millimeters squared, whereas the price is given in meters squared. Or the labor they give you labor in minutes, but the cost for labor is in hours. So you want to be on high alert so that you must know you need to do the necessary conversions. Why is that so important? Because you're going to be so, how can I say, focused in doing the question that you can sometimes just slip up. So before the time, when you put your brain on alert, you don't have to be thinking about that anymore. Your subconscious would be reminding you that your brain is on high alert, and it would send alerts to you when it picks up those type of stuff. Okay, so very important. Train yourself to train yourself to think like that before doing any question. Okay, so let's start with question 1. So we're going to do this 20 marker. So they say ornamental plants specializes in the providing of indigenous plants in ornamental plots for corporate businesses for both indoor and outdoor gardens. Potting, which is a subsidiary of ornamental plants, produces the pots at a fixed markup. Potting currently uses an absorption costing system and is concerned about losses being realized in the potting division. Potting only manufactured one type of pot during the financial year ended 28 February 2017. The following information on standard costs is available. Okay, so now you know this is standard cost for the year ended 28 February 2017. Remember, I always tell you when it comes to costing, you want to identify 3 things, whether it's budget or actual. Budget, standard, same thing. Okay, whether it's budget or actual. Whether you're dealing with a year, a quarter, a month, and then the date. So as you can see, we're dealing with standard, which is kind of budget. We're dealing with a year, and we're dealing with 28 February 2017. In a costing question, there can be lots of information. So generally, if you pick up those subtleties, it will tell you where in the scenario to look. Okay, not so much over here. There's only 1 page. But I'm talking about a big costing question when it's like 3, 4, 5 pages of a scenario. Then that's how you pick up where you need to look. So in that first paragraph, you can see we have a company which is ornamental plant. Ornamental plant have a subsidiary which is what is this? Potting. And you can see the working with divisions, and you can see that what does ornamental plants do? They provide a service to corporates and businesses whereby they provide plants, indoor plants and outdoor plants in pots. Okay, so I'm pretty sure you've seen companies have plants in their business and then outside of their business as well. And you'll see companies coming in to water it and all of those type of stuff. Generally, it's a plant company that does this. Now, take note that they have a divisionalized business. Why this is important? When you see the word divisionalized, what must trigger, because remember, in an exam, you don't know this is a standard costing question because you're reading the scenario, right? You're only going to know once you read the required. Now, when you see the word divisionalized, what must trigger is transfer pricing and management performance. Okay, we're going to do that in a next lesson. So transfer pricing and management performance that must trigger when you see divisionalized. And you can already see that in this scenario that the potting supply, they make the potting for ornamental plants. So that means they produce it and probably sell it on to ornamental plants or something of that nature. So this could easily have been also a transfer pricing or management performance question. So just when you see divisionalized, when you see divisionalization, or when you see the word decentralization, it must trigger. It could be management performance and or transfer pricing. That will be in the next lesson, but I just wanted to pick it up. Wanted to bring it to your attention. But we know in this scenario, we're doing standard costing, okay? Then you can see in this here, they talk about standard cost. You know, standard costing is one of your topics. So that's important. So now you know, okay, it may be a standard costing question as well. What's very important, this is per unit, okay? So we can assume at this point in time that a pot is a unit, okay? Oh, the other thing I wanted to make mention is that they use an absorption costing system. So when they use an absorption costing system, you will have a volume variance for fixed manufacturing overheads, okay? So just take note of that. So here we have per unit. With per unit, so we must know this is a cost for each pot. I'm assuming a pot is a unit. We'll see if that is the case, but just take note of that. Okay, so here we have sales. One pot is sold for 150. Cost of pot sold. Okay, now they're breaking it down. So remember, when the cost of a product is what? Direct material, direct labor, manufacturing overheads. Which manufacturing overheads? It could either be variable. Manufacturing overheads is variable and fixed. Which of those are included depends on the costing system. If you're using the variable costing system, it will only be manufacturing overheads, variable manufacturing overheads. But if it's an absorption costing system, it will be both variable and fixed. So if they didn't tell you this, if they didn't say potting currently uses an absorption costing system, how do you know they're using the absorption costing system? By looking at this. As you can see, direct material, direct labor, variable manufacturing, fixed manufacturing. When you see that, by default, it means they're using the absorption costing system. So there was no need for them to tell you this. Okay, very important. So this is what you need. You must be able to pick up now. So they're telling you that cost of it. So each pot uses 8 kilograms at 185. Okay. So each pot, the standard quantity of input is 8 kilograms. The standard price per kilogram is 185. That's how you get 14 Rand 80. What's very important to take note, they could have given you cement and they're giving you 14 Rand 80. So you know each unit costs 14 Rand 80. Cement costs 14 Rand 80 per unit. So what they could have done is either only give you the 8 kilogram or the 185. So let's say they gave us the 185 and it's 14 Rand 80, then we must be able to work out the standard quantity of input. Because remember, the cost to get to 14 Rand 80 is standard quantity of input times standard price. So 8 kilograms times 1 Rand 85 would give you that 14 Rand 80. So that means they could give us these two without giving us the 14 Rand 80, or they could give us one of these and give us the 14 Rand 80, and we must work out the other one. Very important. Okay, so next to the 14 Rand 80, in brackets, just tell yourself SQI times standard price, which is 8 times 1 Rand 85. That gives you the 14 Rand 80. You want to train your brain to start thinking like that. It's given in this scenario. Many other scenarios don't give all 3 items. So many scenarios don't give all 3. They will give you 2, and you must be able to figure out the 1. So when you read the scenario and they don't give you all 3, try to work out the one as you're reading the scenario with a pencil, write it next to. Very important. So this 14 Rand 80 is SQI times SP, standard quantity of input times standard price. 8 kilograms times 1 Rand 85. That's how we got the 1480. So if they didn't give you any one, you must be able to rearrange that equation to get the other one. Labor, same story. 2 hours at 20 Rand. That is why it's 40 Rand over here. Once again, they could have only given us 2 out of the 3, and we must work out the other one. Once again, SQI times SP. 2 is SQI, SP 20 Rand, that gives you the 40 Rand. Make sure you're picking up this relationship. In another question, they wouldn't give you all 3. Same story, variable manufacturing overheads. They never told us what is the basis of allocating overheads at this point, right? Maybe further on, but at this point, they never told us. But here you can see they're telling you it's hours. So you can already tell yourself that overheads is allocated based on labor hours. Overheads or variable manufacturing overheads is allocated based on labor hours. Remember, each overhead, variable and fixed, can be allocated on different bases. Okay, so variable overheads is based on labor hours. Very important. So that means it is an input. So that means we can have all the possible, variances. If it was based on an output, like units produced, then we wouldn't be able to have all the possible variances. Okay, so it's based on labor hours, because you can see 2 hours times 11 Rand per hour gives you 22 Rand. Once again, SQI times SP. Fixed manufacturing overhead, same story. 2 hours times 10 Rand per hour gives you 20 Rand. So what you can see, fixed manufacturing overhead is also allocated based on labor hours. Okay. So here, the gross profit is 53 Rand, 21.50 minus whatever this adds up to, gives you 53 Rand, 20. Here they're telling you overheads are allocated to production on the basis of labor hours. So they're telling you now the base of allocating overheads is labor hours, which is an input. Remember, you need to know the costing system because it plays a role in which variances we can calculate, and you need to know how you allocate overheads, because it also plays a role in which variances you can calculate. So by having the absorption costing system and having overheads allocated using a base of allocating overheads using an input basis means you can calculate as much variance as possible, excluding now mix and yield. So at this point, you can see that there's only one direct material. There's only one labor so far that we can see. So that means there can't be any mix and yield. But the mix and yield is only possible if there's more than one direct material or more than one direct labor, and they are interchangeable. There's only one, so there's no mix and yield. So they're telling you 20,000 labor hours was budgeted for the year. They also budgeted to sell everything they produced. The actual results for the year ended 28 February were as follows. Okay, so just to take note over here, we are now able to, given the 20,000 labor hours, and given the overhead rate. So this is the overhead rate, 10 Rand per hour is the overhead rate. So remember, how do we calculate the fixed overhead rate? Fixed overhead rate equals budgeted costs divided by budgeted activity. Okay, the budgeted cost, the fixed overhead costs divided by budgeted activity. The budget activity is your basis for allocating overheads. In this case, it is labor hours. So we have the fixed overhead rate, we have the budgeted activity. So that means we can work out the total budgeted fixed costs. Remember, when it comes to fixed costs, don't forget, you must run through your brain the formula for allocating overheads. When using the traditional costing method, always keep in, I'll show you when I go to the Excel, you must always keep in mind the two formulas for fixed overheads, because they're generally going to give you certain information and you must be able to rearrange the equation to get the missing number. So here, they're giving us the overhead rate. They're giving us the activity. So that means we can work out the cost. Very, very important. Okay, so they're telling you they also budgeted to sell everything they produce. So means sales equals production. Okay, so there's no difference between production and sales units. And now they're telling you that actual results for the year ended were as follows. So very important to take note. Very important to take note that generally actual will be given in a total. Okay, so there's no need for you to calculate anything. Okay, so very important. So here you can see total for the year ended for So for direct material or cement is 191,520. So here's what I was trying to tell you. They're telling you that it's 191,520. They're telling you the actual price they paid was 190. So you can really tell that the price variance for direct material is, so you can already tell that the price variance for direct material is unfavorable because they actually paid 190 when we budgeted to pay 185. So what we'll be able to do once we get the actual number of units, we will be able to know how many kilograms per unit we have used. Okay, so here for labor, they're telling us the actual cost of labor, same for variable manufacturing overheads and for fixed manufacturing overheads. So additional information, 2,500 more pots were produced during the year than budgeted, and all pots were sold at 5% higher than initially planned. Okay, so you wouldn't need to work around. Due to recent government interventions, the minimum wage rate was increased for all production workers after the budget of 2017 was finalized. Due to efficient planning, there was no deviations from the budgeted hours worked of 20,000 labor hours. So here you can see we sold at a higher rate, okay? We sold, so 2,500 more pots were produced. Okay, so 2,500 more pots were produced. That means we still need to work out the budgeted pots so we can know the actual production. And they say all the pots were sold. So that means we sold more than what was budgeted for. So the volume variance for sales is going to be favorable, and we sold at a higher rate. So the price variance for sales is also going to be favorable. They're telling you that the minimum wage was increased. So that means the rate is going to be unfavorable, and there's going to be no deviation. So this, the budget actual is going to be exactly the same. Okay, so you must already pick that up from reading the scenario. So for direct material, for cement, I know the price variance is unfavorable. For labor rate, I know the rate variance for labor, or the price variance for labor, is going to be unfavorable. The quantity variance or the efficiency variance for labor is neither unfavorable nor favorable because it was exactly the same. For sales, the volume variance, favorable. For the price variance for sales, also favorable, okay, because it was more than expected. So now what we can do, we can just calculate, go to the scenario and calculate the variance. Go to the required. So they say, I'm only going to do part 14, okay, part B. Okay, so they say determine the total budgeted variable production costs for the 2017 financial year. Okay, remember variable production, it is all your variable costs. Which are our variable costs? Direct material, direct labor, and variable manufacturing overhead. We already have that, but they want total. So we need to work out the budgeted number of units to be produced. Okay, so that we have to work out. Then they say calculate all the appropriate variances in respect of the 2017 financial year. Then provide the journal entries for the material variance, including appropriate narrations. Okay, so we need to do A and B. I just quickly want to stop this so that I can. I just want to stop this so I can get Google Sheets quickly. Okay, so I'm going to do part A. So for part A, they want variable production costs total. Total variable, not per unit. If it was per unit, it was very easy, it would have been a half a mark. But they wanted total. So remember, total variable production would be as follows. And they want it for budget, okay? So they want total variable production costs for the budget. Let's make sure I saw that correct. Total budgeted variable production cost for the 2017 financial year. So remember, they wanted the budgeted total variable production cost. So basically, budget total variable production costs equals, so everything is budget, okay? So I'm just going, so I'm not going to put the word budget because everything is budget. So it's variable costs per unit multiplied by units produced. Okay, so units produced. Okay, so that is basically what they want. So to get budgeted production, so budgeted okay. So that's basically what we need to get. Now so the budgeted variable cost, if you go to the scenario, if you go to the standard cost section, our budgeted cost is, so remember you must distinguish between variable costs, variable manufacturing costs, prime costs, and conversion costs. Prime costs, direct material plus direct labor. Conversion costs, direct labor plus manufacturing overheads. And then variable manufacturing costs is all your manufacturing costs that are variable. Direct material, direct labor, variable manufacturing overheads. Make sure you pick those kind of stuff up. So per unit, it is 1480 plus 40 plus 22, or yeah, 40, 80, 40, 22. So over here, it is going to equal 1480 plus 40 plus 22. Now we need to work out, now we need to work out the actual, the budgeted units to be produced, okay? So this is where the fixed manufacturing overheads come into play. So when you're dealing with the traditional costing method, you must always keep this in mind because they're going to play around with it. And you must be able to manipulate the formulas to get missing numbers. Okay, so I'm going to do this quickly. So it's a common thing that they're going to do, and in ITC as well. So it is something that they love doing, that you must be able to manipulate the fixed manufacturing overheads under the traditional costing method. Okay, so just take a note that fixed overheads applied. So what you apply to a particular product would equal, so what you apply to a particular product would be as follows. Okay, so what you apply to a particular product would be as follows: fixed overhead rate multiplied by, there's different ways to do it. So one would be using activity. So remember, activity is the basis for allocating overheads. Another way to do it, another approach to do it would be fixed overhead applied equals fixed overhead rate times units. Okay, but you must be careful how you use that one. Okay, this is the more accurate one. Now to get fixed overhead rate equals budget costs divided by budget activity. Okay, so budget costs divided by budget activity. So it's very important to take note of that. Please make sure you're able to work through this. When you're dealing with traditional costing and it's fixed overheads. So sorry, when there are fixed overheads, fixed manufacturing overheads, and you're dealing with the traditional costs, just train your brain to run these two formulas through your mind. That overheads applied, meaning overheads applied refers to how much of fixed overheads you're going to allocate to a product. So remember, so fixed overheads applied refers to how much overheads you're going to allocate to a product. So if you go back to the scenario, they told you for each unit, they're allocating 20 Rand of fixed overheads. So fixed overhead applied is 20 Rand. How did they get 20 Rand? They said the fixed overhead rate is 10 Rand per hour, and the activity, which is based on units, which is based on labor hours, is 2. So the activity, 2 labor hours, times the overhead rate of 10 Rand, gave them a fixed overhead applied of 20 Rand. Okay, that's on a per unit level. Now we can do this on a total level as well. To do it on a total level, we need to first work out fixed overhead rate. We know what fixed overhead rate is. It is given to us as 10 Rand. We know the budgeted activity. So remember, this over here must be calculated on a total level. Okay, so that over there has to be done on a total level. We have the total budgeted activity. Remember what is our activity? The basis for allocating overheads. What are the basis for allocating overheads? Labor hours. Okay, so we can rearrange this equation to get budgeted costs. So if I want to get budgeted costs, I have fixed overhead rate and I have budget activity. What I want you to understand, always make sure you know this formula. Always make sure you know that formula, because we can rearrange the equations, either one of them, to get what we want. So I want to get budgeted costs. I have everything in that formula, so I'm okay. I don't have everything in this formula and I want it. What do I want? I want budgeted costs. So if I rearrange the equation, so I'm going to show you, if I rearrange the equation, I'm going to keep budgeted costs on the other side of the equation because I want it on alone and I want it to be in the numerator. So I'm going to take everything on the other side. So fixed overhead rate will remain on this side. I don't want budget activity on the other side. Budget activity is in the denominator. So when I take it to the other side of the equation, it becomes in the numerator. So I say multiplied by budgeted activity. And that's going to equal budget cost. So remember this mathematics. Okay, so you work out the mathematics. So I have fixed overhead rate given to me 10 Rand. Okay, no need to guess. I have budgeted activity given to me 20,000 labor hours. So that means my budgeted cost is equal to 10 Rand times 20,000 labor hours. So my budget cost is 200,000 Rand. Now that I have my budgeted costs, I can work out the units produced. Now that I have my budgeted costs, I can work out the units produced. So just to show you, this is the correct way of calculating it. Okay, so this is the correct way of calculating overheads applied and calculating fixed overhead rate. But you must be able to switch your brain to change this formula. Okay, you must be able to switch your brain. This is the technically correct way of calculating it. But you must be able to switch your brain to use that formula as well. So this one over here is the technically correct calculation, but you can also use it based on units produced. In this case, you see I didn't use the term activity. In this case, I did not use the term activity because activity refers to the basis of allocating overheads. If allocating overheads was based on units produced, then there's no need to use the formula we're going to do now. But because the activity is not based on units produced, in order to get the units produced, we're going to have to use this adjusted formula, if I can put it that way. Okay, so I don't want to call it an adjusted. You're not going to find the textbook called the adjusted formula. I'm just calling it that to make your brain realize the switch. So to get units produced, we're going to use that formula. So this is what you must take note. Fixed overhead applied just think of something quickly. So we can do this. So this formula is actually like this. Budget costs. I don't want to call it overhead rate, but overheads applied. So that is what I want to do. So budgeted costs is equal to fixed overheads applied times units produced. Very important to take note. Okay, so have a look at this over here. We want units produced. That's what we want. So if I have units produced on one side, the formula is rearranged as budget costs divided by fixed overheads applied equals units produced. You need to get used to these formulas. Like if I'm you, I would sit literally 30 to an hour just working through those three formulas. Because having those three formulas is knowing those three formulas inside out how it works. It's going to make your life so much easier. It only counts maybe 2-3 marks, but you need that for the rest of the question. This was one of the things that threw me off in my ITC exam. So I wasn't like too clued up on fixed overheads. Since then, I made sure I was clued up on fixed overheads. It's a little bit too late because it was after the ITC, but at least when I needed to tutor. So make sure you're able to manipulate fixed overheads. You want to know that formula. So I'm going to highlight it in green, the formulas you want to be able to know. So these formulas highlighted in green, make sure you know it and you can manipulate it to get what you want. These formulas highlighted in green, critical, okay? Maybe very small marks, but it plays a huge role for the rest of the question. So indirectly, it's a lot of marks. So if I want units produced, I need budget costs and I need fixed overheads applied. Okay, so that's very important. So we want units produced. Okay, so we need budgeted costs. We calculated budgeted costs. Budgeted costs is 200,000. Okay, so that is working one. Now this is where you need to just pay careful attention. The amount I'm going to put in over here is not the 10 Rand. I'm not using the fixed overhead rate. The fixed overhead rate is 10 Rand. I'm using fixed overheads applied. Just go to your scenario. Maybe I just want to go to it quickly. So here, the fixed overheads applied, the fixed overhead rate is 10 Rand, but the fixed overhead applied is 20 Rand. So what we're going to put in over here is a fixed overhead applied, which is 20 Rand. So that will tell us how many units. $200 divided by 20. So the budgeted units to produce is 10,000 units. So now we know budgeted units is 10,000 units. So now we can finish this off. Units produced or budgeted units produced is 10,000. So variable manufacturing costs is 76 times 10,000 units, which is budgeted cost, which is 768. Okay, so just take note of that. So very important to take note. Those three formulas are extremely important. These two, they're going to use, it's going to come in basically, if I can put it this way, it is so important that although I can't say it like this, but just to emphasize the importance that you need to know it 100% of the time, because the chance of it coming in is virtually 100%. And when it does come in, they're going to play around with you being able to manipulate the formula. So here you can see they gave us everything relating to that. They gave us the fixed overhead applied, which was 20 Rand. They gave us a fixed overhead rate, which was 10 Rand per hour. They gave us the activity, the budgeted activity, which is 20,000. Which was 2. So 2 times overhead of 10 Rand gave us a fixed overhead rate, gave us a fixed overhead applied of 20 Rand per unit. Then run through your mind that although they give you the fixed overhead rate, run your mind through the formula of the fixed overhead rate just to ensure that you have everything. Because you ultimately would like to be able to calculate the fixed overhead rate. So although they told us the fixed overhead rate is 10 Rand, through your mind, you want to tell yourself, okay, I want to be able to calculate that 10 Rand. You know to get that 10 Rand, it is budgeted cost divided by budgeted activity. So when you run through your mind, you want to get to that 10 Rand, you say, okay, where's budgeted costs? Where's budget activity? You see they gave you budgeted activity of 20,000. That then triggers. So now automatically you know you don't have budgeted costs. So now automatically you know you will most likely need to calculate it. That is why you want to run the formula through your mind. So when you deal with fixed overheads, run the overhead, run this formula through your mind and run that formula through your mind. The reason why I run it through your mind, it's going to help you identify what is given and what is not. Because what is not given will most likely need to be calculated. Okay, then you want to run this formula through your head as well. That budgeted costs is equal to overhead applied per unit. So those 20 Rand applied per unit times unit produced. that's also going to help you to find the missing figure. So it's going to help you to identify what is given and what is not, because then you will know whatever is not given is going to have to be calculated somehow through these formulas. Okay, very important. Train your mind to start thinking in that way. So my answer would be that you can check the solution. I'll check the solution later on to see whether we got the answer right or not. Now we can do part B. Now we can do part B, because now we have units produced. We needed unit produced to get to actual units. Okay, so now we can do part B. So I'm going to stress again, fixed overheads, that's not specific to standard costing. It is applicable to costing as a whole. When you are using, when you see fixed overheads and it's using the traditional costing method, you want to make sure those three formulas you run through your mind so you can identify what is missing and what is given. Because what is missing may be required to be calculated. Okay. So they just say calculate the formulas in as far as possible. So what you must know, what you need to know, the formulas would be, we know there's going to be a sales formula. There's going to be a direct material formula. Variance, sorry. Direct material. So we know we need to do variances. So there's going to be a sales variance. There's going to be a direct material variance, and you want to tell them the direct material in this case is cement. Okay, so we're going to say variance, and then we're going to say cement, because they gave it to us as cement. And then we're going to have a direct labor variance. And then there's going to be, what's another one? Variable manufacturing overhead variance. And there's going to be a fixed manufacturing overhead variance. Okay, so now we have the categories. Now we can plug, now we know each variance can be broken up into two, a price or a quantity and a price, a quantity and a price. Okay, so I know I need a quantity variance and a price variance. So for sales, I need a quantity variance and a price variance. The terminology for quantity variance is volume variance. Then I have a price variance, and we can call it a price variance. And then under direct material, I have a quantity variance and a price variance. Let's call that quantity variance and a price variance. Direct labor, I have a quantity variance and a price variance. The quantity variance is referred to as efficiency variance. And the price variance is referred to as a rate variance. Variable manufacturing overheads will be exactly the same. It was based on labor, exactly the same. Efficiency variance and a rate variance. Then for fixed manufacturing overheads, so remember, you can have a volume variance and a spend variance. So sorry, this is not called the price variance for variable manufacturing overhead, is called a spend variance. Then the quantity variance is known as a volume variance. And then for the price variance, it is known as a spend variance. Okay, so that is basically how we do that. Now remember, the volume variance, so this variance, the volume variance can be broken down further if there's more than one product. They only have one product. So we can't break down the sales volume variance into a further variance. The quantity variance can be broken down into a mix and a yield. Only if you have more than one direct material. There is no more than one direct material, so we can't break it down further. The direct labor efficiency variance can also be broken down further if it's more than one direct labor. There is no more than one direct labor, so therefore we can't break it down further. Remember, you can only have the variable manufacturing overhead efficiency variance if we're allocating overheads using an inputs basis. We are using an inputs basis because we're using labor hours, so we can have that. The volume variance, you can only have a volume variance if we're using the absorption costing system. We are using the absorption costing system, so therefore there is a volume variance. The volume variance can be broken down further if we are using, if we are allocating overheads using an inputs basis. Because we are allocating overheads using an inputs basis, there will be a volume variance. I mean, we can break down the volume variance further. So we can have capacity variance. I don't remember the formula, I need to look it up. Capacity variance and what's the other one? Efficiency variance. So remember, you must know when to use this. I just have to see, okay, something right way. Indent restart. Others, here probably insert. Does anyone know how to do the indenting on Google Sheets? Okay, I'll figure out, I'll go Google it later. Just gonna do this quickly. Just leave that like that and just do these two. Okay. So now we can now we can plug in the formulas. Okay. I need to remember these formulas. I'll go look it up just now while we do that. So remember, for the volume, let's do this first. Okay, let's just do this. So remember, for the volume variance, we're comparing quantities. We're comparing actual quantity to standard quantity, and we hold the price constant. Which price do we use? The budgeted or the standard price. When we are doing the price variance, we're comparing pricing, standard price with actual price, and we hold quantity constant. Which quantity? Actual quantity. Train your brain to think, train your brain so that you don't get confused. Okay, so for volume variance, remember for sales, so remember, like we said, we're comparing quantities, actual versus, so actual quantity sold versus budgeted quantity sold. Okay, and we usually multiply it by standard price. Like we said, with sales, we don't use standard price. We either use standard contribution margin or standard gross profit. Because we're using the absorption costing system, we're going to use standard or budgeted GP. Why do we not use standard price? Because when you sell more, or when you lose a sale, you're not solely gaining or you're not solely losing the sales value. Because if you, let's say you're losing a sale, you don't lose just the sales price, but you also save on the variable costs. As a result, what takes place is that what's only being lost is either the contribution margin or the GP. And that is how we use GP over here. Now remember, we have our GP. Our GP was given to us as, so it's budgeted GP or standard GP, was given to us as 53 Rand 20. Okay, so that's easy. Multiplied by actual quantity sold. So remember, units produced equals units sold. Units produced equals units sold. So the units produced of 10,000 was also budgeted to be sold. But what happened? 2005. So they say they also budgeted to sell everything they produce. So what did they budget to produce? 10,000, and they also budgeting to sell everything. So budget equals sales. Units produced equals units to be sold. Okay, budget. Then they say 2,500 more pots were produced during the year than budgeted, and all pots were sold. Okay, so using that information, so actual quantity sold, 12,500. To 10,000 plus 2,500 more. So it's 12,500 minus budgeted quantity sold, 10,000. Okay, so just if you have any questions, just ask me. Okay. Price variance, we're comparing pricing. Okay, so for price variance, we're comparing pricing. Actual price minus standard price. Okay, actual selling price minus standard selling price. Because we're comparing, so price variance, we're comparing actual price to standard price. So what do we all constant? Quantity. Which quantity? Actual quantity. So here we're going to say actual quantity sold multiplied by. So let's just do this quickly. So let me just do this. So I'm going to say working one. So remember, units produced. Or let's put this budget. Budget units produced in 1,000. We're going to say this is from A actually produced 2,500 more. So actually produced, okay, actual production, actual units produced equals that plus that. Okay, then we say budget production equals budgeted sales units, actual units produced equal actual sale units. Okay, so you can know. So that I put this in over here, working one. Okay, remember you could have just done what I did in my actual calculation. I'm just doing it so if you do work through it again, you actually understand what we're doing. Just so you know, you don't have like all the calculations I do. You don't have to do all those type of calculations as a working. I'm just doing it so when you work through, it's self-explanatory. So working two, we want to get sales price. Okay, so remember actual sales price. So standard selling price was given at 150. 5% increase. So 5%. So what's the actual selling price? So actual selling price is equal to 150 multiplied by 1 plus 5%. Okay, so 157.50. So what do we do? So actual quantity sold. So actual quantity sold So actual quantity sold is actual quantity sold 12,500 multiplied by actual selling price minus standard selling price. Okay, so 93,750. We expected this to be favorable. Okay, we expected this to be favorable because we sold more than budgeted, so that is favorable. Favorable. Okay, because the price we got was more than budgeted, it is favorable. Now we can get direct material quantity variance. So remember the quantity variance, we're comparing actual quantity to standard quantity. And then we hold the price constant. Which price do we hold constant? The standard price. So remember here is where we have to flex the budget, okay? So here is where we have to flex the budget. How do we, so remember it's going to be standard quantity minus actual quantity. Standard quantity minus actual quantity multiplied by standard price. We hold the price constant. Which price is constant? Actual standard price. Just remember, SQ, standard quantity, is SQI, standard quantity of input, times actual units produced. Okay, so just take note of that. So let's deal with that. So let's have a look. The standard price per kilogram is 185. Okay, so standard price per kilogram was given to us as 185 multiplied by standard quantity. Standard quantity per unit. So the SQI is quantity per unit, 8 kilograms per unit multiplied by actual number of units. So multiplied by 12,500. Okay. Minus actual quantity. They never gave us actual quantity. They never gave us actual quantity, but they gave us total price and they gave us price per, they gave us price per quantity. So therefore we can work out actual quantity. So working let's just do that for now. So actual quantity is as follows. So remember, total quantity cost total cost of actual quantity could I remember what was 191,520. So 191,520. We got price per quantity, just so you know, kg, price per kg. It was given to us as 190. So that means we can work out the actual quantity, total actual quantity used. Total actual quantity is going to be equal 191 divided by 1.9. So the actual quantity used is 100,008. So 100,800 kilograms. Okay. So just to so you can see whether it's favorable or not before the time. You can see how much they used per unit. Okay, so remember, you don't need, so what I'm doing now, you don't need to do, I'm highlighted in yellow, you don't need to do it. I just want to show you something. So actual units produced is 12,500. So this will tell you how much kgs are used per unit on average. So actual quantity used per unit. So as you can see, we budgeted to use 8 kgs, but we used 8.064. So we used more than was budgeted for. So the answer we expect above is unfavorable. So you didn't need to do this. I just wanted to show you. You must spend some time in working through these formulas and making sense of it. If you're just going to memorize it, it's gonna confuse you. So try to just spend a little bit of time, like 30 minutes or 60 minutes, try to understand how the formulas work, so that it becomes easy for you. So working 3, we're gonna minus over here. So remember what we did of that over there is SQI, 8 kilograms per unit multiplied by actual units. So that bracket is flexing the budget. Okay, so there you can see, just look what Google Sheets is telling you, came to 100,000. But what did our actual quantity come to? So standard quantity is saying it should have been 100,000 kilograms. But what was actual quantity? Actual quantity was 108,000. So you see, we used too much. So you'll see the answer will be negative, which means it is unfavorable. You can either use adverse or unfavorable. You must use a terminology that they give you. They never gave us anything. So you can use either one. Okay, adverse or unfavorable. So you can see what you call it. Now we're going to do the price variance. We know the price variance is also unfavorable because we budgeted for 185, but we actually paid 190. When we are doing the price variance, we're comparing pricing. So standard price to actual price. And we hold the quantity constant. Which quantity? Actual quantity. So actual quantity purchased multiplied by so actual quantity purchased multiplied by standard price minus actual price. So remember, actual quantity purchased happens to be the same as what was, so it's 12,500 multiplied by standard price 185 minus actual price 1.9. It's negative, so it is unfavorable. Okay, then we have the efficiency variance. So it's the same formula. We're comparing quantity. In this case, hours, right? So it is standard quantity times actual quantity. But we don't call it quantity, we call it hours. So standard hours minus actual hours. What do we hold constant? The price, the rate. Which price, which rate? The standard price, the standard rate. Okay, so remember, it's going to be standard price, which we call it standard rate, multiplied by standard quantity versus actual quantity. But we don't call it quantity, we call it hours. So standard hours minus actual hours. Okay, now remember, this standard hours, we have to work it out in a specific manner. So standard hours, we need to flex. We need to flex the standard hours. How do we flex the standard hours? Standard quantity of input times actual units produced. So we know what is the standard rate. I think we know what the standard rate is. The standard rate is 20 Rand per hour. Okay, so we know the standard rate is 20 Rand per hour. So it's equal to, so I'll put the equal to afterwards. It's equal to 20 Rand per hour multiplied by. Now we need the standard hours. But how do we get standard hours? Standard quantity of input. So each unit requires 2 hours multiplied by actual units, which is 12,500 units, minus actual hours. They never gave us actual hours, okay, but we can work out actual hours. Okay, oh, actual hours was same as budgeted hours, so it is 20,000. Okay, so actual hours, it is 20,000, because they told you there was no deviation from the budgeted hours. Okay, so there we go. So now I can plug in equal to. So as you can see, it is favorable because we should have used 25,000 hours. We should have used 25,000 hours, but we actually still used our budgeted hours of 20,000. Okay, so that's why it is favorable. But we know there was an increase in labor rate. So we know the rate is going to be unfavorable. When we're doing the rate variance, we're comparing standard rate to actual rate, and we hold the price constant. I mean, we hold the quantity constant. Which quantity? The budgeted quantity. So remember quantity, we're going to say hours. So, I mean, not budgeted quantity, actual quantity. So it's going to be actual hours multiplied by standard rate minus actual rate. Okay, so remember, actual hours was 20,000, budget and actual happened to be the same. So actual hours is 20,000 multiplied by the standard rate is 20 Rand. We need to get the actual rate. So we can work out the actual rate. So the actual rate is going to be, so working for the actual rate, total actual labor costs, total actual labor costs, 530. You just check it by using the right number, 530. Actual total actual hours, 20,000. So actual rate per hour, you'll give us answer, gives us 2650. Okay, so we go over here, 2650. So it's more than what we budgeted for, so we expect it to be unfavorable. Okay, so therefore it's negative, unfavorable. Okay, now we can come to the efficiency variance. It's going to be basically exactly the same. So the standard rate was a standard rate 11 Rand. So the standard rate is 11 Rand multiplied by standard hours. So remember, the standard hours will be quantity of input times units produced, which is the 2 hours of quantity input times actual units, 12,500, minus actual hours, which is 20,000. So this will be favorable. Okay. This will be unfavorable. The reason why it's going to be unfavorable based on labor rate. So actual hours, 20,000 multiplied by actual rate, which is 20 Rand, minus standard rate. I don't know. Sorry. What am I doing over here? R11 per hour. $2,500 more pots were produced during the year than budgeted, and all pots were sold due to recent government. Okay, so we can work out variable manufacturing overhead. We can work out the rate. Okay, so we're going to work out the rate for that. So let's take away this one now. So for variable manufacturing overheads, we can work it out, working 5. Can work out the actual rate. I'm going to use the same over here. So working 5, total actual variable manufacturing overhead cost, which was given to us as 269,123. Remember, manufacturing overhead is still based on labor hours. Actual hours was 20,000. So the cost is 1345. As you can see, budgeted cost is 11 Rand. Actual cost 1345. So therefore, it's going to be unfavorable. Okay. Now for the spend variance, the spend variance is simple. You simply take actual versus budget. Okay, so the spend variance, remember fixed overheads. So this is budget minus actual. Remember for fixed overheads, it doesn't, because by definition, fixed overheads does not change relative to output. So you're simply going to say budget, which was 200,000, minus actual, which is 515, 123. Huge difference. So this is adverse, unfavorable. Okay. I just want to check on volume variance and capacity. If you have any questions, let me know. Do you have any questions? I just want to check the textbook quickly to do capacity and efficiency variance for volume variance. I cannot remember. Is there any questions from your guys' side? Ashita, Lerato, Nasreen?
No, fine, thank you.
Ashit, okay, Lerato, Tandy, Valise, Rebecca.
No questions.
Okay, I just want to quickly check. I cannot remember. I just check the textbook quickly for capacity and efficiency variance. Okay, just give me 2 minutes. Okay, guys. I'm going to look through the capacity and efficiency again. I've figured it out, but I just need to think of a way to explain it first. So I'm not going to explain it now. We'll still do the volume variance. Okay, we'll do the volume variance. I'm not going to split it up over here. So remember what the volume variance is simply. It is basically, you can use this formula. Actual production minus budget production multiplied by fixed overhead applied per unit. Okay, so you can use that formula. So I'm just going to cut it out quickly. Control X. I'm going to plug it in over there. So it is actual production minus budgeted production and we're going to use fixed overhead applied. Very important per unit. Okay. So that's very important to understand. So if you go to the scenario, the fixed overhead applied per unit. So remember what I told you over here. Very important to distinguish between fixed overhead applied. So we're using that over there, fixed overhead applied per unit, which is 20 Rand, which is that over there, fixed overhead applied per unit, which is that 20 Rand. Very important. Distinguish between fixed overhead rate and fixed overhead applied. Very, very important. So the fixed overhead applied, if you go to the scenario, I'm going to switch my screen for you quickly. You go to the fixed overhead applied. So remember the fixed overhead rate is 10 Rand. Fixed overhead applied is 20 Rand per unit. So we're going to plug in over there, the budgeted fixed overhead per unit. It is 20 Rand multiplied by actual production, 12,500 minus budgeted production, 10,000. So we produced more than what we budgeted for. So we expect a favorable volume variance. We produced more than what we budgeted for. So there's a favorable volume variance. I'll just figure out, I'll do it another time with you guys, how to split this out. I just want to work through it on my own first myself and then think of a way of explaining it so that you can remember it and never remember it. So that is that over there. I just want to, over here, just this over here. So I was going through the formulas. Remember, when we're doing the direct material variance, the price variance, we're comparing pricing. Which pricing? Standard price to actual price. And then we must hold the quantity constant. Which quantity? Actual quantity. But remember, this must be, I see I put the wrong quantity in. Not units, it must be the quantity purchased. We don't purchase units, we purchase kilograms. It is that. So just make sure you plug in the right numbers. So please make sure you plug in the right numbers. So just take note, it is the quantity we are using is not the units produced. When I was going through, I saw I plugged in units produced, but it's not units produced because we don't buy, when we go to the store, we're not buying completed pots. We are buying cement in kilograms. So it is the kilograms. Just make sure you put in the right number. Okay, so that's all I wanted to show you over there. Okay, the rest is fine. I'll show you how to split this up. I'm not going to do it now. I want to work through it myself first. Okay. Is there any, but these are basically the formulas that you will use, and it should work 100% of the time, all the time. Just very important to take note that over here, that SQ, the actual formula is the same. SQ, it is standard quantity of input times actual units. That is flexing the budget. If you don't do that, you're going to get straight zero because you're not flexing the budget is extremely important when it comes to this question. Another important aspect to take note, over here, they gave us all three items. They gave us standard quantity of input, they gave us standard price, and they gave us the price per unit. They don't have to give you all three in this, they can just give you one of it. Similar to how they did it over here. Okay, similar to how they did it over here. They never gave you all three, they gave you on a total level. So please make sure you can manipulate all these type of formulas. Okay, that's all I wanted to cover for today. Is there any questions from your guys' side?
No questions.
Anything confusing? What did I just do there? Ashita, anything confusing your side? Nasreen, anything confusing your side?
No, okay so far.
Okay. Ashita. Okay. Rebecca. Tandy. Okay, Felice. I'm assuming you're okay still. Okay, so please make sure you practice. This is a nice question to start with. Okay, this is a nice question to start off with. Everything is clean, simple scenario. It won't always be like that. I'll just give you one thing to be aware of. In this scenario, for direct material, remember, for direct material, you must always distinguish between quantity purchased and quantity used. In quantity variance, we must use quantity used. Okay, in price variance, we must use quantity purchased. In this scenario, quantity used, quantity purchased was the same, but it's not always going to be the same. When they give you an opening and closing balance for quantity for direct material, then you must know the quantity used and the quantity purchased will most likely be different. Okay, so just be aware. They kept it clean over here. So please take note of those kind of small subtleties. So if I'm you, redo this question as to solidify standard costing before you go into a more complex scenario. Okay, so this is an easy one. Before you go into a more complex one where there's just lots of moving parts. Yeah, they kept it nice and clean. It's nice that they kept it so nice and clean. So use it as a practice to solidify standard costing before you go on to another question. Okay, so I'm going to stop there for today. I will send this out later today. Okay. See you guys. Thank you for joining today's class. Bye-bye.